Hi everybody, this is a video that I'm creating for the Warp Investor blog for this blog post. The title of the post is How Inflation Widens the Wealth Gap. And for this video, I'm going to discuss two figures that are included in the post. And this is the first. So this figure shows two tables, left and right, and they have, so these two tables show the progression of pay and difference saved for two individuals, one low pay, one high pay, and for two inflation rates, 0.5% on the left and 5% on the right. In both cases, the individuals start at low pay with 50K per year, and then the high pay is 100K. So the high pay is twice as the low pay. And the assumption here is that the low pay individual earns enough only to survive paycheck by paycheck, whereas the high pay saves the difference. And in this case here would be 50,000, and that is saved, and then you have the salaries are corrected for inflation, so you have the difference goes up in value, and the value that is saved also gets corrected for inflation. So you end up over 20 years to these values here, which are a little over $1 million in wealth, let's put it this way, for the high pay individual with 0.5% inflation, and 2.5 million for the situation where the inflation rate is 5%, so it's much higher. You always need some inflation, otherwise you get into a situation where the inflation is negative. And when inflation is negative, people stop buying. They don't want to buy today because they know that a month from now, prices will be lower. So that can have a severe impact on economic activity until prices go down so much that then the inflation restarts again. So this is a reset. But typically you would want, under normal conditions, to have some inflation. 0.5% would be very low. The target for the central bank in the United States and many other central banks is 2%. 5% would be higher than that. Now, one looking at these numbers, a person looking at these numbers would say, well, the inflation rate doesn't make any difference because this 2.5 million at year 20 would buy the same amount of goods and services that this one at 0.5 inflation, 0.5% inflation. In other words, this number in absolute terms look higher, but because of the inflation rate, it will be worth about the same as this number with lower inflation. And the same is true for the pay, right? So the pay here to 252,000 and some change compared to 126 is equivalent to the 109K compared to 55K at a low inflation rate. So the argument would be that this doesn't matter. It doesn't make any difference in real terms, in terms of wealth. Now, my argument is that it does. In fact, it creates the higher inflation rate, creates a bigger difference in wealth over a number of years. And the reason is because of a couple of things that are illustrated in this next figure. So in this next figure, this figure here that you're seeing on the screen, what we have is the inflation rate for information technology products and services. And as you can see, for many years already, this inflation has been largely negative, meaning prices have been going down for IT products and services, which illustrates the fact that the inflation rate has a number of items, and some of those items are not actually inflating in price, which means that if somebody has a correction for inflation rate that is higher because overall inflation is higher, that person will be able at any point in time, especially at year 20, to buy more IT products and services because those are not experiencing inflation. So that's one reason why the wealth gap widens with higher inflation. Is because some items of inflation, they just are not inflating. So if you get a higher absolute amount over a number of years, that higher absolute amount will be enough to buy many more of those non-inflationary products and services. The other reason that high inflation causes a wealth gap is that over time, there will be periods like this one here close to 2008 where the inflation will go down significantly, will be very negative. And in fact, for some assets, it could be minus 50% or even more. And this happens regularly. So whenever recessions happen, the prices of certain goods and services will go down dramatically. One example are stocks, right? Shares of publicly traded organizations, companies. For some companies, that price during an economic downturn of the shares will go down 80%. But if you have a higher absolute amount in dollars because of a high inflation rate, you may be able to buy more of those shares, which return to the mean in terms, or figuratively speaking, return to the mean, and therefore are much cheaper than before. With a higher absolute amount, you're going to be able to buy more of those assets. And this goes also for other assets like big assets like homes, for example. So these are the reasons why at a higher inflation rate, you may end up after a number of years with a higher absolute amount that inflation corrected would be similar to a lower absolute amount, but this will buy more of certain things if there is an economic downturn, or if the specific item had not inflated, actually went down in value. And IT products and services are becoming more and more a component of the costs of the middle class in the United States and many countries. So a high inflation rate does widen the wealth gap between those who have and those who have not. Thank you for watching.